Welcome to The Explainer. Today, we're diving into DBS Group's second quarter earnings for 2025. And what a quarter it was. The bank faced some serious headwinds, but still managed to deliver some pretty standout results. So much so that the market loved it, sending the stock to a record high. DBS's own CEO, Tan Su-shan, really hit the nail on the head. She called the whole situation a perfect storm. You had lower rates, trade issues, crazy currency swings, the whole shebang. So let's unpack that and figure out how DBS not only navigated the storm, but actually seemed to use it to their advantage. So you have all these challenges lined up, right? But here's the thing. The bank didn't just survive. It really thrived. I mean, they beat profit expectations by a solid $50 million. Their stock price hit an all-time high. And maybe most importantly, they stood by their full-year guidance, even while some of their competitors were getting nervous and trimming theirs. So the big question is, how on earth did they manage to do that? All right, first things first, let's get into the numbers. Because the Q2 scorecard, well, that's where this story of resilience really comes to life. So the headline number, the one everyone was talking about, is that profit beat. DBS brought in $2.82 billion in net profit this quarter. That's about $50 million more than the analysts were expecting. It's just a really clear sign that they're executing incredibly well, even when things get tough. Okay, now this slide is where things get really interesting. You gotta look at the story behind the numbers here. Yeah, sure, net interest income grew by a modest 2%, but look over at assets under management. That's the money they manage for clients. It's up a massive 16% compared to last year. And that points to the real engine of growth this quarter, diversification. And boom, this chart just says it all, doesn't it? That little 2% bump in net interest income, the profit from their basic lending business, it was just dwarfed by an 11% jump in their other income. And what was the powerhouse behind that? A jaw-dropping 25% surge in wealth management fees. You're seeing their diversification strategy pay off right before your eyes. So the key takeaway here is to understand the strategy behind all these numbers. I mean, this wasn't just a lucky quarter. It was a very clear three-part playbook that literally turned those economic headwinds into powerful tailwinds. Let's break it down piece by piece. The answer? Well, it starts with the absolute star of the show this quarter, an incredible knock-it-out-of-the-park performance in wealth management. And we're not just talking about a little bit of growth here. This was a blowout. Get this. They pulled in an incredible $9 billion in new money this quarter alone. That is almost double what they typically bring in. And it's all driven by this really smart strategy of serving everyone, from your average retail client all the way up to the ultra-wealthy. Plus, they're perfectly positioned to capitalize on all the global capital flowing into safe havens like Singapore. They're not just a temporary parking spot for cash. They're building these sticky, long-term relationships. But wealth management, that was just one part of the story. They also put on an absolute masterclass in defending their business from falling interest rates, which, is a huge headwind for any bank's core lending business. And their secret weapon, their main tool, is something called balance sheet hedging. To put it simply, it's kind of like buying an insurance policy for your income to protect it against unpredictable moves in interest rates. And DBS has been so proactive here. They've been using these hedges with about a 3-year duration on average, which basically locks in yields and protects their income. Now, the thinking here is subtle, but honestly, it's brilliant. They care more about growing their total interest dollars, the NII, than just chasing a higher profit margin on each loan, the NIM. It's a strategy that focuses on the absolute amount of profit, not just the percentages. All right, so the final piece of their playbook is all about the future. And it's a big, very deliberate push into the world of digital assets. So they're building this whole digital asset ecosystem. But there's a catch. It's for institutional clients, and it operates on these super secure private blockchains. This business-to-business focus keeps them on the right side of the regulators while they build what's already looking like a highly profitable, scalable business. I mean, it's already on track to more than triple last year's revenue. So naturally, the analysts on the earnings call had some pretty tough questions. Let's look at what they were really focused on and how the management team handled it. No surprise here, the number one question, the top concern for investors, was all about the dividend. Is it sustainable? Can it keep growing? Because in a world this volatile, cash returns are king. Management's answer was really firm, really confident. They basically signaled that, yeah, they can likely raise the dividend this year and next year too. And it's all thanks to a strategy of taking their huge deposit growth and putting it into low-risk assets. This lets them grow earnings without tying up too much capital, which paves a really clear path for shareholder returns. Analysts also wanted to know where future loan growth was going to come from. And it's a fair question, especially when you see things slowing down in key markets like Hong Kong and China. The answer from management pointed right back to their home turf, Singapore. Turns out demand from Singapore's own big companies in these really high-growth areas, think tech, media, renewables, infrastructure, it's still incredibly strong. And it's providing a powerful counterweight to the slowdown they're seeing elsewhere. Okay, so what does this all mean for the future? Well, as we look ahead to the next earnings call, we are putting an outperform rating on DBS. And here's what we're going to be watching very closely to see if they can maintain that momentum. So, to justify that outperform rating, these are the key things to keep an eye on. Can their clever hedging strategy keep working its magic as central banks make their next moves? Will regulators open the door for even more growth in digital assets? And here's the big one. Was that S9 billion wealth inflow just a one-time thing? Or is that the new normal for DBS? The answers to these questions, well, they could send the stock even higher. And just a final reminder, as always, this explainer has been for informational purposes only, and this is not financial advice.